Hello, I'm Ryan Lightfoot-Brown of Fund Calibre. I'm joined today by Ian Simmons, manager of the Magna Emerging Market Dividend Fund, which is on Fund Calibre's elite radar. Ian, thank you very much for your time today.
Thanks for having me back, Ryan. Good to be here.
Now, if we can start with the income side of your fund, many of our investors and our viewers will be wondering how to fill some of the gaps after last year. How have dividends held up in emerging markets and your fund in particular?
Yeah, so I'm sure lots of your viewers will be watching the FTSE with close interest, and we're expecting now dividends to be down 20 to 30% in the UK for 2020. And emerging markets have suffered. They've fared a little bit better. The expectation now is that they have tracked earnings downwards by maybe about 15 to 20% through the full year. And of course, some companies suffered, but we also had a bit more regulatory interference in emerging markets. We had some local regulators banning or suspending dividends in particularly sensitive sectors, such as financials, which had an impact as well. And for the fund itself, I'm pleased to say we fared somewhat better than the broader emerging market benchmark. In fact, the last 6 monthly payment, which we made at the end of last year, was more or less flat year on year in sterling terms, so up in local currencies for emerging markets. And we had a small drop in the payment at the start of the year, which was right in the middle of the crisis. So understandable, I think, for companies to be cautious at that point. But the implication is for the full year, in local currency terms, dividends were more or less flat for the portfolio that we have.
And I noticed that in the fund, some of the companies that you hold have been in those areas that have been most hard hit by the pandemic, some in sort of domestic travel names, some physical retails and some financials, which you touched on. Can you talk us through some of these, please?
Yeah, sure. So no surprise that travel was very heavily impacted last year with the pandemic and the travel restrictions around the world. We own a couple of casinos in Macau. We have an airport operator in Mexico. And so clearly these went through a few months of very minimal revenues and earnings. But as soon as vaccines are rolled out and the lockdowns end, there's nothing which makes us think that the reasons that we bought these companies years ago won't reassert themselves again. People will travel again. And, in the case of Macau, where Chinese tourists probably won't be able to travel internationally for still quite some time, Macau could be a big beneficiary as it's a tourist hotspot that they can access already. So we would expect some shorter term rebound there. For the banks, which you mentioned, now they had their branches closed, but the bigger impact was the fact that they have to take provisions up front very early on to protect against any future asset quality problems which their own customers may have faced. And that clearly has a big impact on earnings and, as a result, dividends. But again, what we've seen from the best run banks and in the banking industry, being conservative and acting prudently is the most important thing to survive. What we've seen generally is that they have taken more than enough in the way of provisions already, in some cases too much. And so they can start to reverse those in the coming months, and that should lead to a very rapid rebound in earnings quality from the banking sector. And the final sector that you mentioned, retail, again, following a similar pattern. If you have physical stores, they've been closed for a period of time through 2020, and that had a negative impact. Not so much food retailers, supermarkets were open, but things like fashion, for sure, they had a big negative impact. But speaking to the companies that we have in this space, in the likes of Brazil and China, they're back to 95+% open again already. And what's interesting is that in all these examples, a strong balance sheet allows these companies to often come out of a crisis in stronger health. So we've seen some of them consolidate the market, make acquisitions to grow their business through the last 6 months.
And what about some of the companies that have been benefiting from some of the trends and those sort of structural growth themes we've seen going on in the likes of sort of renewable energy and maybe the technology names as well?
Yeah, there's no doubt that that's been a great place to be involved in the last 12 months. And renewables, electric vehicles have led the way, really. They have benefited from big government pushes, not just in China, but around the world. Governments have made very clear their ambitions to take ICE vehicles off the road. And that's a very interesting structural growth area. Now, the problem from a dividend point of view is that a lot of the consumer-facing companies that make the end product, like the electric cars, are still loss-making, certainly have no intention of paying any dividends in the near future. So for us, what we prefer to do then is look at the supply chain and identify good companies which will benefit from the same trends, but which have a more proven business model already generating cash to pay out as dividends today. And that led us to a company, Zinyi Solar, which is the world's largest solar glass manufacturer. It's very unlikely now to be dislodged from that position now that it has the scale and the expertise to really continue to benefit and keep expanding from the growth in demand. And in tech more broadly, there's no doubt that the perceived COVID winners were the big internet companies, the e-commerce companies, gaming companies, anything that helped us live online. But again, few of those pay dividends. So where we focus our attention there is in the hardware that actually allows them to scale and to deliver improved products to their customers. And again, we get to tap into the same kind of growth. So, for example, the chips that big players like TSMC and Samsung Electronics are producing will continue to be a key part of the backbone for greater digital penetration in our daily life.
And thinking more sort of top level, geographically, the US is maybe quite far away from many of your investments, but politically, it's still very important. So what sort of impact does a Biden presidency mean for emerging markets?
Yes, I think it's the result which most emerging market investors wanted to see, especially after they took the final 2 seats in Georgia in the Senate to give Democratic control of the Senate. And what the expectation is that will lead to a much larger stimulus, which will be favorable for commodities. It puts pressure on the dollar and can lead to a steepening yield curve. And we're starting to see all of that play out already this year. It helps, of course, that he's arrived at quite an opportune moment in terms of vaccine progress that will help his efforts to reopen the economy. But looking historically, a weaker dollar has always been favorable for emerging markets, and rising rates, certainly at the long end of the curve, does seem to have started some rotation towards sectors and countries that were left behind last year, both EM more broadly relative to the US, but also within emerging markets. We're seeing some of those regions like Latin America start to recover some of their losses. But politics is politics, and it changes every few years. So what we are ultimately much more interested in is the trajectory of earnings over the longer term for our companies. And so while the reopening trade is positive, it's the long-term earnings power of our companies that is really most important and will deliver stock returns over the years. And that's much more driven by on-the-ground fundamentals rather than any change in American politics.
Well, Ian, as ever, that was really interesting. Thank you very much for your time today.
Sure, no problem. Thanks a lot.
And if you'd like to find out more about the Magna Emerging Market Dividend Funds, please visit our website, fundcalibre.com. And if you've enjoyed this video, don't forget to give us a like down below, and don't forget to subscribe to hear more from our elite rated managers.